A beginner's guide to investing. Different types of investments and how to start investing. Investing is one of the most powerful ways to build wealth and secure your financial future. Yet, for many beginners, the world of investing can seem confusing, filled with jargon, charts, and endless options. The truth is, investing doesn't have to be complicated. It's about understanding where to put your money so it can grow over time. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. Understanding the basics of investing. Before diving into specific investments, it's important to understand what investing actually means. Investing is the process of allocating money with the expectation of generating a profit or income over time. Unlike saving, where money is simply stored in a bank account, investing involves taking some risk for the potential of higher returns. The main goal of investing is to grow your wealth faster than inflation, so your money maintains and increases its purchasing power. There are many ways to invest: stocks, bonds, real estate, mutual funds, ETFs, cryptocurrencies, and more. Each has different levels of risk and reward. A key principle of investing is diversification, which means spreading your money across different assets to reduce risk. Beginners should also understand the concept of compound interest, the idea that your investments earn returns on both your initial money and the returns it has already earned. Over time, this can lead to exponential growth. Stocks. Stocks, also known as shares or equities, represent ownership in a company. When you buy a stock, you're purchasing a small part of that business. If the company grows and becomes more profitable, the value of your shares often increases, and you may earn dividends, a portion of the company's profits paid to shareholders. Stocks are one of the most popular investments because they offer the potential for high returns over the long term. However, stocks also come with volatility. Prices can fluctuate daily based on company performance, market conditions, and investor sentiment. For beginners, investing in individual stocks can be risky without research or experience. A good starting point is to invest in broad market index funds, such as those that track the S&P 500, which give exposure to many companies at once. This reduces the risk of poor performance from any single company. Patience is key. Stocks reward long-term investors who can ride out market ups and downs. Bonds. Bonds are fixed income investments where you lend money to a government, municipality, or corporation in exchange for periodic interest payments and the return of your principal at maturity. They're generally considered safer than stocks because they provide predictable returns and less price volatility. Common types include government bonds, corporate bonds, and municipal bonds. For beginners, bonds can serve as a stabilizing force in a portfolio. While they may not offer the same high returns as stocks, they provide consistent income and reduce overall risk. Bonds also perform well during times of economic uncertainty, making them a great diversification tool. However, inflation can erode bond returns over time, and rising interest rates can lower bond prices. Mutual funds. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Managed by professionals, these funds make investing easier for beginners who may not have the time or knowledge to pick individual investments. Investors buy shares of the fund, and returns are based on its overall performance. Mutual funds come in various forms. Equity funds focus on stocks, bond funds on fixed income, and balanced funds mix both. They can be actively managed, where fund managers select investments, or passively managed, where the fund tracks a specific index. ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. They offer diversification, transparency, and typically lower fees than mutual funds. ETFs track indexes, sectors, or commodities, giving investors easy access to different markets and industries. Because they trade throughout the day, Investors can buy or sell them whenever markets are open. Real estate. Real estate is one of the oldest and most reliable forms of investment. It involves purchasing property, residential, commercial, or rental, with the goal of earning income or profit. Real estate investments provide dual benefits: regular rental income and potential appreciation in property value. It also acts as a hedge against inflation since property values and rents often rise with prices. While real estate offers stability, it requires significant capital and ongoing maintenance. For beginners with limited funds, real estate investment trusts, REITs, are a great alternative. REITs allow you to invest in property portfolios without owning physical buildings, and they often pay attractive dividends. Real estate can diversify your portfolio and provide a steady income stream when managed wisely. Cryptocurrencies. Cryptocurrencies like Bitcoin, Ethereum, and Solana have revolutionized modern investing. These digital assets operate on blockchain technology and are decentralized, meaning no central authority controls them. They offer immense potential for high returns, but they also come with significant risk due to price volatility, regulation uncertainty, and technological complexity. Retirement accounts. Retirement accounts like 401ks, IRAs, and pension plans are designed to help you save for the future with tax advantages. Contributions may be tax-deductible, and earnings grow tax-deferred or tax-free depending on the account type. Many employers also offer matching contributions, essentially giving you free money for investing in your future. Investing through retirement accounts ensures consistent, disciplined contributions that compound over decades. Beginners should start early and contribute regularly. Diversify across stocks, bonds, and mutual funds based on your age and risk tolerance. Even small contributions can grow significantly through compounding. Avoid withdrawing early to maximize long-term growth. Index funds. Index funds are a type of mutual fund or ETF that tracks a market index, such as the S&P 500 or NASDAQ. They offer automatic diversification and low management costs, making them ideal for beginners. Since index funds simply mirror market performance instead of trying to beat it, they usually outperform most actively managed funds over time. Beginners benefit from index funds' simplicity. Just choose a broad index and invest regularly. The long-term growth of the market works in your favor, and you avoid emotional decision-making. How to start investing. Starting your investing journey can feel overwhelming, but following a structured plan makes it manageable. First, define your financial goals: retirement, home ownership, or financial independence. Then, assess your risk tolerance and investment timeline. Next, create a budget that allows you to set aside money regularly for investments. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.